Hello everyone. Today we are going to start your accounting concept. I want to say that this syllabus is related with your class 11 and 12 concepts, so you have to be very much clear with the accounting concept. So if you are not clear enough, you have to go through the slides and the videos again and again to make perfection in your concepts. Now, beginning with your accounting concepts, let's first start with what is accounting. Now, as you see here, what is accounting? I'll just read out the summary for you first. Accounting is defined as the art of recording, classifying, and summarizing transactions in monetary terms, in money terms, for preparation for financial statements. Now, when we say accounting is defined as the art of recording, these three things, that is recording, classifying and summarizing, it is very important to know, because here only all the meaning of accounting is given. What do you understand by recording, what do you understand by classifying, and what do you understand by summarizing? It is very important to know what is transaction. You should know what are the transaction and the monetary terms. So what are the key points we need to see in accounting? First is, it is the art of recording, classifying, summarizing transactions in monetary terms. Now, let me explain to you first what is this recording, classifying, summarizing transaction in monetary terms. Now, recording, whenever we are recording something, we will be recording the transactions. Now, when I say transaction, some of you might not know what is transaction. Transaction means it is a day-to-day event which takes place in our daily life. Now, what is this day-to-day events? Now, suppose you go to the shop to buy something. Now, let's suppose you are buying one pen. One pen is costing rupees 10, right? So if that 10 rupees, you have to give it to the shopkeeper to take the pen. So when you are doing this event, that is known as your transaction. That means you are giving the money to the shopkeeper, rupees 10, and the shopkeeper is giving you the pen, right? So whenever you are doing any kind of buying or selling of any kind of items, it is known as your transactions. Hope I'm clear with that. Now, for these transactions, how to record this transaction, how to classify, and how to summarize. Before this, in your class 11 and 12 lessons, you might have heard about journals, ledgers, and trading account, trial balance, profit and loss account, and balance sheet. Whenever we are recording any kind of transaction is what? Whenever any kind of buying and selling of items takes place in the business is known as transactions. For recording those transactions, we use the books, that is your original book of entry, which is known as journal. Next is classifying. For classifying, we are using the ledgers. That is, when you are after recording the journals, you have to post it in the ledgers. Then we have to classify it according to the different names of the ledgers. Whenever you are passing the entries in the ledgers, you are classifying the items in the ledger. It is known as posting of transactions. Then the last one is your summarizing. Summarizing means wherever the debit and credit side. Debit means whatever comes to you, and credit means whatever goes out from you. So all the summary of debit and credit need to be summarized in your trial balance. So what are journals, what are ledgers, what are trial balance? We are going to discuss in your further slides in detail. So I hope I have cleared with you, you are cleared with your recording, classifying, summarizing and transactions. Now in terms of money or in monetary terms, what is this in monetary terms? In money terms, whenever you are buying something, it is related with money. If it is not related with money, you cannot say that it is a accounting transaction. Let's say give an example. You are buying a pen. I'm giving you the same example. You are buying a pen. The pen cost is 10 rupees from the shop. Now when you go to the shop to buy the pen, you give 10 rupees to the shopkeeper and you buy the pen, right? But now this is a accounting transaction. Now let's say the same example. If you are buying one pen and you are not buying it, actually you are just borrowing one pen from your friend, and he or she is giving you the pen. You are asking from your friend one pen to borrow, and then he or she is giving you pen in return to you. There is no monetary transaction when you are borrowing from your friend, right? So that will not be taken as your accounting transaction. Only those items, only those transactions where money is involved, money is coming in or money is going out, then it is a monetary term. So in accounting, we always take into consideration only the money value of the transaction and nothing else. Hope it is clear to you. Now what is accounting? Again, let's just revise it. Accounting is defined as the art of recording, classifying and summarizing transaction in monetary terms for preparation of financial statements. Right? Now what is recording? Recording means whatever transactions you want to record, you'll be recording it in journal. Classifying will be done in your ledgers and summarizing will be done in your trial balance. Now, let's see again for this preparation of financial statement. What is this financial statement? Financial statements are your profit and loss account and the balance sheet. Now, profit and loss account is prepared to show the net profit and net loss of your business, whether the business is earning profit or whether the business is earning any kind of loss. What is another part of financial statement? It is balance sheet. Now what is balance sheet? It is the account which shows the assets and liabilities of the business. What are assets? Assets means all the properties belonging to the business. What are liabilities? Whatever you are due to the business, any kind of obligations, dues by the company to the outsiders is known as your liabilities. So we prepare the balance sheet to show the assets and liabilities of the business. Assets and liabilities should be balanced in the balance sheet. So I hope you are clear with this. Accounting, what is the definition of accounting? Accounting is the art of recording, classifying and summarizing transaction in monetary terms in preparation of financial statement. I'll repeat it, I'll make it very clear to you. Now recording is your journal, classifying is ledger, summarizing is your trial balance, and all the transactions have to be in terms of money, and the financial statements have to be prepared. That is your profit and loss account and the balance sheet. Next we go to the next slide. Now here also another meaning of accounting is given. Whichever you feel like writing, you can write it down in your notes. Accounting is an information system, is the process of identifying, measuring and communicating the economic information of an organization to its users who need the information for decision making. Next, moving on. Meaning and definition of bookkeeping. Now, bookkeeping and accounting. Some people might think that bookkeeping and accounting are the same thing. But bookkeeping and accounting are not the same thing. Now, what is the difference between this bookkeeping and accounting? First of all, let's see the meaning of bookkeeping as given here. Bookkeeping includes a recording of journal, posting in ledgers, and balancing of accounts. all the records before the preparation of trial balance is the whole subject matter of bookkeeping. Now here what we are going to see is, in the starting of the video, I have already told you what is the meaning of accounting, right? So I have mentioned there that accounting is the recording, classifying and summarizing of accounts, right? Now when we include only those three parts, that is your recording, your classifying and summarizing, it is known as your bookkeeping. But when we are preparing the financial statement, that is your profit and loss account and balance sheet, it becomes your accounting. Hope it is clear. Bookkeeping is only till recording of journal, posting in ledgers, that is your classification, balancing of account, that is your summarizing only. But in your accounting, we are including this recording, classifying, summarizing and the preparation of financial statement is the accounting. But in bookkeeping, we stop where? We stop till the summarizing part. We do the recording, we do the classification and we do the summarizing only. We don't prepare the financial statement in bookkeeping. Hope it is clear. Now bookkeeping is a shorter term and accounting is broader term. Next, moving on to the next slide. Now again here, now you see definition of accounting is given. Now definition, whenever you are writing any kind of definition or studying the definition, it should be exactly the same as it is given by the person or by the institute itself. Whenever you are writing any kind of definition, it have to be within the quotes given in the definition, within the quotation, opening quotation and the closing quotation. Now this is very important. Now you see here accounting, definition of accounting given by AICPA. Now what is this AICPA? American Institute of Certified Public Accountants, which defines accounting as, what is the definition given by AICPA? The art of recording, classifying and summarizing in a significant manner and in terms of money, transaction and events which are in part at least of a financial character and interpreting the results thereof. So this definition is coming under the quotes, right? So we have to remember all the lines, all the commas and the full stop of this definition. You cannot skip one word from here because it is defined. It is defined by an institute. So you cannot make this definition by your own words. It has to be as it is given by the institute. But if you are writing the meaning of any kind of definition, the definitions of accounting by your own words, then you need not mention these quotation marks. You can write it in your own words. But any kind of definition, if it is given by some institute or by some authors, then it have to be as it is given, explained by the institute or by the authors. Now here in the definition of accounting as given by AICPA, it is also the same thing they are writing here. It is the art of recording, classifying, summarizing in a significant manner the money, the transaction and the financial statement. So hope this is clear enough. Moving on to the next slide. Now let's see what are the objectives of accounting. Objectives of accounting: to keep systematic record, to ascertain the results of the operation, to ascertain the financial position of the business, to portray the liquidity position, to protect business properties, to facilitate rational decision making, to satisfy the requirement of laws. Now what are all these? These are just the points given as the objectives of accounting. Let's discuss one by one. To keep systematic record. Instead of writing to keeping systematic record, it should be to keep systematic record. Now, what is the systematic record? Systematic record means you need to record the transaction, whatever purchasing or selling of items takes place in the business, it have to be recorded systematically. Now, the first step in making the accounts is that you need to make the journal. Journals are used mainly for recording your transactions. What are transactions? Transactions are your purchase and sale of any kind of items in the business. Now, these items have to be recorded first. Without recording, you cannot classify it. You cannot classify it and you cannot summarize it. So the first step in making the accounts is your journal. That is, you have to record the transaction in the journal. Next, you have to classify those items in your ledgers. Whenever you are passing the entries in the ledgers, it is known as your posting of ledgers. And next, the third step will be your summarizing. Now, what is summarizing? As I have explained to you, summarizing is the balance of debit and credit shown in the trial balance. So, this should be systematic. If it is not systematic, it will not be good for the organization. So I'll repeat one more time. What is systematic record? Systematic record is first you record in the journal, then you classify it in the ledger, and then summarize it in the trial balance. So next is your to ascertain the result of the operation. To ascertain the result of the operation means what result you are getting from the recording of those accounting. Every business, their main aim is to earn profit, right? So if you are earning profit or loss, it have to be given. It have to be shown in the business, in the accounts. Now, what is this? To ascertain the results of the operation. To ascertain the results of the operation means to show the profit or the loss of the business. The business, sometimes the business might get some profit, and in some years they might suffer some loss. So in these cases we have to show the result of the accounts. Now, the results of the accounts can be shown where we can find out the net profit and net loss of a business. We can find it by preparation of trading profit and loss account. Right? Now here, when we are saying trading profit and loss account, what is trading account? Trading account are those accounts which are related with your direct manufacturing units. That is direct, all the direct expenses and incomes are recorded in your trading account to show, to get the result of gross profit and gross loss. And what is the use of net profit? Net profit and net loss are shown in your profit and loss account. What is net? What is the difference between the gross profit and net profit? It have to be very much clear with you. You have seen, you know, you all know how to make the trading account, the profit and loss account, the balance sheet, right? So in trading account, we are preparing the trading account for calculating the gross profit and gross loss. Why it is getting gross profit and gross loss? Because of the direct expenses or incomes of the department, of the manufacturing unit. And in case of profit and loss account, we are getting net profit and net loss. So what is the difference between this gross profit and gross net profit? The difference between this gross profit and net profit is that in net profit, to get the net profit or net loss, we get it by deducting your tax amount and deducting your depreciation amount. Okay. So what I told you, it is gross profit is the total of all the direct expenses and income which is shown in the trading account, and net profit and net loss is shown in the profit and loss account after the deduction of tax and any kind of depreciation. So hope the second point is clear. Next is to ascertain the financial position of the business. Now what is this financial position of the business? Financial position means the preparation of your balance sheet. Now in balance sheet we prepare the assets and liabilities of the business. What is assets? Assets are the properties of the business. What are liabilities? Liabilities are the obligations of the business. So to know how much assets you are having in the business and how much liability you are having in the business, we need to prepare the balance sheet, which is known as a financial position of the business as well. So this is the third point. Hope you have understood this. Next is to portray the liquidity position. Now what is this liquidity? Liquidity means easy convertible into cash. Which items can be easily convertible into cash? Easy money. Easy money is known as your liquidity position. So all these things in detail we'll be learning in your next chapters as well. Next is to protect business properties. To protect business properties is like whenever you are making any kind of accounts, the items or the assets are always belonging to your business, right? So we have to have that objective in the mind of the workers or the employees of the organization, that they protect the properties of the business. Properties of the business means the assets of the business. They need to take care of the assets of the business very well. Moving on, next, to facilitate rational decision making. To facilitate a rational decision making. What is decision making? To decide how the organization is going to earn a profit in the future. And if what is this rational? Rational means very carefully taking a decision. Now if you are not taking the decisions very carefully in the future, you might not be able to earn that much profit how much you have expected. It might suffer loss. So in that case, to avoid to suffer any kind of losses, the decision needs to be rational. What is rational? Rational means careful decision making. Hope it is clear. Next, moving on, to satisfy the requirement of law. To satisfy the requirement of law means whenever you are making any kind of accounts, it needs to be fulfilled. It needs to be fulfilled all the laws which is given in the company's law. So when accounts are prepared, it have to follow certain kind of laws which have to be legal and which have to be followed by GAAP. GAPs are your generally accepted accounting principles. All the principles have to be followed to prepare the accounts. That's why all the laws have to be followed for making any kind of accounts. So I hope you are clear with your objectives of accounting. Let's moving on to the next slide, that is the functions of accounting. What are the functions of accounting? Record keeping function, that is the primary function. Managerial function, decision making. Legal requirement function, that is your auditing. Language of business, that is all the parties which are involved in the business for knowing the results of the business. Now let's see this one by one. What is this record keeping? Record keeping function. This is the primary function. I have been explaining to you again and again about this record bookkeeping. Now, what is record keeping function? It is the recording of your transactions. What are the recording of transactions? That is your journals, your ledgers, and the trial balance, right? So record keeping function, this is the primary function. Primary function means it is the main function of accounting, that is to record the transaction, to classify the transaction, and to summarize the transaction. Next, come to the managerial function. Managerial function is what? Decision making. Now, in the objective we have seen that the decision making have to be rational. Careful decisions have to be made to achieve the objective of the business, that is to make the profit in the business. It is the decision making function. It is also called as the managerial function because the managers are the persons who are going to take the decision for the business. Next is legal requirement function. Now, legal requirement means it is related with your law. Now, here it is saying auditing. Auditing means whenever you are making any kind of accounts, it need to be audited by the auditors. What is auditing? Auditing means to check whether your accounts prepared by the organization is correct or not. Now, you'll understand this if I give you one example. Let's say as a student, you are studying. You have to study all the materials which will be provided to you in the classes, right? So after you have studied your lessons, you need to show your performance. How you can show your performance? You can show your performance whether you are doing good or doing bad in any kind of examination. If exams will be there, then only we, the teachers, can find out whether the student is doing good or not. So for that reason, we need to do the examination. So in the examination, what we are doing actually, we are checking your performance, right? Whether the student is doing good or doing bad. So same way in accounting as well. When we are making the accounts, the accountant will make the accounts, right? They will record the transactions, they will classify it, and they will summarize it in a systematic manner, right? But whether those accounts are correct or not have to be checked. So that checking is known as auditing. In accounting terms, it is known as auditing. Hope it is clear. Next goes to the language of business. Now, what is this language of business? Language of business means when we are making the accounts, we are showing the balance sheet, right? We are showing the financial position of the business, which is the balance sheet, where we show the assets and liabilities of the business. So what is the point of making that balance sheet? Why we present that assets and liabilities? Why it is required to show the assets and liabilities of the business? It is required to show the assets and liabilities of the business so that the parties like the owners, the creditors, the government, the employees of the business must know what is the business is doing, how the business is doing, like whether the business is having proper assets, how much liability the company is having, how much profit the company is having, how much losses the company is suffering. So all these details, not only the employees of the companies are interested in that. Which parties are interested in knowing the position of the business? They are the owners of the business, the creditors of the business, the government, the employees. All these parties are interested in knowing the result of the business, right? So these are all the functions of accounting. What are the functions? I'll repeat one more time. That is your record keeping function, that is your primary function. Managerial function, it is helpful in decision making, and decisions have to be very much carefully made. That is, next is legal requirement of functions, that is checking of your accounts, that is done in auditing. Language of business, these are all the parties which are interested to know the financial position of the business. So next, let's move on to the next step. Now, what are the steps involved in the double entry system? Now, double entry system, or else you can say it is an accounting system. Now, first of all, in the definition itself, I have told you it is all about recording, classifying, and summarizing of transactions. So now we are going to learn in detail what is the preparation of journal, what is the preparation of ledger, and what is the preparation of financial accounts. But first of all, let's say preparation of journal. What is journal? Journal is called the original book of entry. It records effects of all transactions for the first time. Here the job of recording takes place. So recording, what I have told you that recording is always done in journal. What it is also known as, it is also known as book of original entry. Book of original entry. Whenever you are buying something or selling something, when you want to record it, you will be recording it in the journal. And it is also said that it is record all the transaction for the first time. For the first time, that means recording have to be done in the journals whenever the purchasing or selling of items takes place. Hope it is clear. Next, preparation of ledger. What is ledger? Ledger is classifying. Ledger is the collection of all accounts used by the business. This is known as what? The collection of all the accounts. After you have made the journal, you go to the ledger where it is showing the collection of accounts. Here the grouping of accounts is performed. Journal is posted to ledger. So posting of ledgers. This is saying that posting of ledgers. Whenever we are making the ledger, whatever transactions we have recorded in the journal need to be posted in the ledger. What is ledger? It is the group of accounts, grouping of accounts or collection of accounts is known as ledgers. Next, move on. Trial balance preparation. Next is trial balance preparation. Where we do trial balance preparation? We do it in the summarizing part. What is this? It is a summary of ledger. This should be ledger balances prepared in the form of a list. This is not ledge, actually this is ledger. So kindly make the correction. It is a summary of ledger balances prepared in the form of a list. Now what is this list? It is prepared in the form of list, means you have to make two columns, that is your debit and the credit. Debit means what? Whatever has been coming to you, what comes into the business is the debit side, and credit side means whatever goes out from you or from the business, it is the credit side. So when we are summarizing it in the trial balance, it have to be in the form of this list. What is this list? That is the debit and credit of the items in the business. So the last one, it is the preparation of final account. Preparation of final account is the profit and loss account and the preparation of balance sheet. So I have told you what is profit and loss account. Profit and loss account shows the net profit and the net loss of the business, and the balance sheet shows the assets and liabilities of the business. So these are the steps which you have to remember and which is very important to know when you are learning accounting. The first step, I'll repeat one more time. First step is your journal. Next step is your ledger. Next is your trial balance. And the last one is your final account, that is It is a combination of two accounts, that is profit and loss account and the balance sheet. Let's move on to the next slide. Accounting cycle. What is this accounting cycle? As an information, it is given as input, process and output. Now what are all these things we will be discussing? This is just a diagram of this accounting cycle, and all these things we will be learning in our next slides in your other classes. So for today we have done, let's see what we have learned from the beginning. We have learned what is accounting, the meaning of accounting, the definitions of accounting, the objectives of accounting, the functions of accounting, and the steps involved in your accounting. Right? So hope you all have liked the video. If you have liked it, kindly click on the like button, share and subscribe.